We've all heard about the proverbial black swan, something that comes out of left field that nobody saw coming and that just rocks global markets and finances. But sometimes it's something that is right before our eyes in plain sight. Last week, midweek, I believe on the 21st, Japan's bond yield spiked 25 basis points. Kind of sent shockwaves through their system. It did have some reverberation effects, on the U.S. markets later in the week. But I saw a story yesterday, a very well laid out, detailed story from Bloomberg I want to share with you now. Because from my reading of this as a layperson, leave me your thoughts and comments. This is just the beginning of what we're going to see come out of Japan. I did a video a few weeks ago on the so-called yen carry trade and the unwind of the yen carry. I'll link that at the end. If you didn't see it, go back and check it out. This is developing. It's something that is a $7 trillion problem for global markets. So before I jump into the stories, I always humbly ask if you guys aren't subscribed to the channel, please subscribe so we can keep growing the community. I appreciate you being here. So out of Bloomberg yesterday, Japan bond crash unleashes $7 trillion risk for global markets. Days after Japanese bonds crashed, sending tremors through global financial markets, traders were still stunned by the speed and breadth of it. A quarter-point surge in yields in a single session. A fund manager, a Pacific investment management company, said, let that sink in. In the Japanese government bond market of old, it would take weeks, sometimes months, for yields to eke out tick by tick a move of that magnitude. For most of the 21st century, it says, the JGB market was so steady and interest rates were stuck at such rock bottom levels that Tokyo was viewed by investors around the world as a source of both cheap funding and of stability during times of global turmoil. Last week's sell-off, it says accompanied by dramatic swings in the yen, made clear those days are over. Inflation, long dormant in Japan, has taken hold, and Prime Minister Takashi is pushing fiscal stimulus plans that would swell a government debt pile that's already uncomfortably large. As a result, it says investors have been frantically sending bond yields up to levels once unthinkable, more than 4% on the longest dated JGBs. That's exerting upward pressure on interest rates from U.S. to Britain and Germany. It says as Japan hurdles towards a February 8th snap election for which both Takashi and her rivals have campaigned on looser budgets. An even bigger worry for global markets, it says, over the long term is that the new normal of higher Japanese yields will prompt domestic investors, and here we go, to bring back home much of their money. Some $5 trillion of the country's capital is deployed overseas. Guys, much of that is right here in the United States. And that's even before accounting for the yen that foreign funds have borrowed for their wagers in financial assets around the world. And that includes massive investments in private credit vehicles here in the U.S., guys. I'm editorializing, but I've covered this before on the channel. That's why it's a big deal, something we got to really pay attention to. It's a new era, said this guy Kochugi, executive chief fund manager at Mitsubishi UFJ Asset Management, one of the nation's biggest investment firms. Quote, I don't think Japan's yields have gone far enough yet. That is just the beginning. There's a chance that bigger shocks will happen. T. Rowe Price's Arif Hussein describes Japan's rising rates as a financial San Andreas fault line, with each tremor leading to feverish speculation over when the big one will come. Tuesday's sell-off, it was Tuesday and Wednesday of last week, stands out. The plummet in ultra-long debt wiped out $41 billion across the Japanese yield curve after Takachi called the election to strengthen her grip on power and ensure support for her agenda of high spending and tax relief. The 40-year bond yield burst above 4%, it says, to a record, while 30-year yields surged more than a quarter of a percentage point, 8 times the average daily trading range over the past 5 years. That's not a small thing, folks. The shock reverberated across the world, sinking treasuries and becoming an unexpected focus for all the financial heavyweights who were then gathered in Davos, Switzerland. An analyst from Goldman Sachs Group suggests every 10 basis points of idiosyncratic JGB shock puts around 2 to 3 basis points of upward pressure on the yields in the United States and elsewhere. Think about that. And if that would start to compound itself, what it would do to U.S. yields here and therefore, by extension, our markets. It later emerged that the Federal Reserve Bank of New York contacted financial institutions to ask about the yen's exchange rate, a powerful signal to anyone betting against the currency that authorities in both nations may be preparing to intervene. Since for some it was another sign of the administration's concern that trouble in Japan is a threat to U.S. markets. And here's a very, very, very powerful statement. If the yen slides hard, Japan has to defend it, and the fastest lever is selling reserves, including treasuries, said Anthony Doyle, Chief Investment Strategist at Pinnacle Investment Management. That's how a Japan problem turns into higher U.S. yields at exactly the wrong moment. It says the friction's been building in Japan's markets for some time. The first big warning shock came in mid-2024 when the second increase in interest rates sent the yen soaring. Equities and global bonds sank as investors rushed to unwind as much as $1.1 trillion worth of positions built on borrowing cheaply in the yen. Reassurance from the BOJ that it would take a gradual approach. The policy rate is only 0.75%. 2 years after it started hiking, restored a measure of calm, but it also encouraged investors to start borrowing the yen again to fund purchases of higher yielding assets outside of Japan, including massive purchases here of treasuries and private credit and all those other kinds of things here in the United States. Okay, so that's the risk that this unwind poses to the United States and our markets. It says the sell-off in bond yields gained more force before erupting in the chaos seen last week. The selling drove the 30-year bond yield up as much as 75 basis points to a high of more than 3.8% in less than 3 months. It says it had taken most of all of last year to move that same amount. The danger is that Japan was a market that never moved, and now you're dealing with a level of volatility that is remarkable, said Ugo Lancioni, a fund manager at Neuberger Berman. It's still unclear how high yields would need to go for the Rubicon to be crossed, it says, for Japanese investors to pull money home en masse. But many large institutions are looking more favorably on their home market, meaning institutions in Japan. For example, Sumitomo Mitsui Financial Group, Japan's second largest lender, said last week it would aggressively rebuild its government bond portfolio at the expense of foreign markets. Quote, I always loved foreign bond investment, but not anymore. Now it's JGBs. The group's global markets head, Nakata, said in an interview. Okay, so this is a massive sea change. They're going to be focusing inward on their own country at the expense of what they've got sitting in treasuries and investments in the United States, folks, okay? This is just getting started here. Even the conservative Japanese life insurers who hold the equivalent of more than $2 trillion in securities are reconsidering a decades-old reliance on foreign markets as yields at home become more attractive. Says, we have a couple dangers. One is the elephant in the room for global markets is repatriation flows, and what I just discussed a few minutes ago, in the form of a carry trade unwind. Okay, and I'll wrap it up here. On Friday, the BOJ kept its benchmark rate unchanged while raising its expectations for higher inflation. Japan has got itself into a really vulnerable position, said Marlboro Investments athlete. If authorities simply ignore these moves, and the market could get really dysfunctional, and they will then have to respond to a much worse situation. So the question will be, how do they respond? Do they respond after the fact? Do they get ahead of this? The February 8th snap election's taking place. Let's see how that plays out. But this all will come back, it'll come home to roost, so to speak. So, I'll link the video I did before on the yen carry trade unwind. Leave your thoughts and comments. If you guys enjoy the content, please leave me a like on the video. Please subscribe to the channel if you're not subscribed. And with that being said, I will talk to you soon. Bye.